pronounced it very well. So thank you to Neil and also Christian for inviting me to present our paper. So it's fantastic to have this opportunity. So this is joint work with Paul Schneider, who is at the Swiss Finance Institute in Lugano. All right, so what do we do in this paper? For the motivation, we are going to depart from two facts. The first one is that we know that the absence of arbitrage is going to be a fundamental pillar of asset pricing. And second, we also know that the linear asset pricing models are going to be widely used, both in academia and in the industry, for things like prediction, pricing, and benchmarking. Now, we also know that while they can rule out statistical arbitrage in large cross-sections, right? So think about the Ross arbitrage pricing theory. They can imply, however, some arbitrage opportunities in smaller samples, right? So if you don't let this number of assets to go to infinity, then you can have some arbitrage portfolios. So let me build up a bit more upon this last bullet point here. So we know that under the no arbitrage, we are going to have a stochastic discount factor, right? Let's call it M. And if the no arbitrage condition is satisfied, then this stochastic discount factor M has to be positive in every state of the world, right? And we know from the Euler pricing restrictions that if we were to take the product between the stochastic discount factor and any excess market return or excess return on any asset I, in expectations by the no arbitrage, this should be equal to 0. The problem is that in practice, we do not know what the stochastic discount factor M is going to be, right? So one approach would be to just rely on economic theory. And this is going to make predictions about the stochastic discount factor M. And this is going to be typically often up to some few parameters. So if you were to think about the kappa M world, we know that the stochastic discount factor is going to be linear in the excess market return. Now, what might be some issues here that could arise in linear models? Well, let's assume that we fix for simplicity the mean of the stochastic discount factor to be equal to 1. You could see that unless one imposes some strict restrictions on these parameters, linear models are not always going to satisfy the no arbitrage restriction, right? So you could have some states of the world in which this linear model could become negative. Why is this a problem? Why should we care about it? Well, it turns out that if this linear model becomes negative, then it could imply some arbitrage opportunities for nonlinear payoffs, right? And in particular, we know that linear models are not going to perform very well, especially during bad market conditions. So in this paper, what we do, we are going to ask how can no arbitrage help us correct linear models? So what we are going to do is the following. We are going to propose the smallest modification to a linear asset pricing model that is compatible with no arbitrage. And the way in which we are going to do this, we are going to add an economically motivated correction. And in particular, it's going to have this nice additive form. So the stochastic discount factor M is going to be additive, is going to have as a leading term the linear model, and then it's going to have a nonlinear component. And the way in which we are going to do this, we always want to benchmark against the linear model. So we are going to focus on polynomials of even degree that are going to be positive. You may be wondering why not simply have, for instance, an exponential model, which could ensure that the stochastic discount factor is always positive. Well, it turns out that this decomposition is going to have some nice properties. And in particular, in our framework with the linear model, we are always going to price exactly those assets that constitute like the linear span of the assets or the basic assets. In our framework, think about stocks and bonds. This nonlinear component is only going to be there to ensure that M is going to be positive, right? So such that we have a valid stochastic discount factor. So this nonlinear component is going to be orthogonal to the linear model and its component. It's going to have mean 0, such that it doesn't have any price impact on the assets that are priced by the linear model. And it's also going to have minimal volatility. Now, in order to also identify this linear model, we want to be agnostic about which is going to be the correct factor model driving the underlying returns. And following the intuition from the seminal work of Hansen and Jagannathan, we are going to recognize that the model with the smallest variance is simply going to be a linear combination of the assets that are available to investors, right? So essentially what we are going to have in this paper is that the linear model is simply going to be a linear projection. Think about the Hansen-Jagannathan one on the set of assets that are available to investors. And then this nonlinear component is going to be there to ensure that the no arbitrage condition is satisfied. So obviously there are many different ways by which one can describe or introduce a nonlinear stochastic discount factor. Our nonlinearities are only identified from the no arbitrage restriction. And why do we do this? Why do we focus on this particular form? Well, because we want to have as a benchmark the linear model. So in our framework, the linear model is going to be the leading term. So let me summarize what I have just described. We have that M star, which is the linear model, is going to be the linear projection from Hansen and Jagannathan. This nonlinear component is going to be polynomial. And obviously, in order to be positive, it has to be a polynomial of even degree. And we are only going to focus on positive polynomials. It's going to have minimal volatility. It's going to be orthogonal to the linear model. So then it's also going to have no price impact for the basic assets. Again, think about stocks and bonds. And polynomials are going to be a natural way for us to do this because they are going to be the only class of models that can nest the linear model as a special case. Now, of course, Hansen and Jagannathan, in their paper, they also have a version in which they have a non-negative kernel. However, that's the positive part of the linear model, right? So it has an option type payoff, which is in general more difficult to estimate in practice, and especially if one were to focus on conditional models, which is going to be also the focus on our paper. All right. So what we are going to do, we are going to let the data choose the optimal conditional stochastic discount factor, and we are going to focus on the minimum variance one. And we know that in economic terms, this is also going to bound the maximum attainable Sharpe ratio in the economy. The only condition that we impose is going to be no arbitrage. So again, the linear model is going to be correctly specified for the basic assets. In our context, think about international stocks and bonds. The nonlinear component, it's only there to ensure that the no arbitrage condition is going to be satisfied. So of course, the methodology is going to be very general. As you might have guessed from the title, we are going to focus on international markets. And we believe that international markets are going to be a natural laboratory for various reasons. First, we know from previous literature that exchange rate and currencies in general are going to have a strong factor structure, right? So if you want to give a fighting chance to this linear model, we should naturally start from such an economy. But then we also know that the foreign exchange markets is going to be among the largest and most liquid market, right? So it's less likely that it's going to be prone to other financial frictions that you could have in less liquid markets. And lastly, if you were to compare the cross-section of currencies with the cross-section of equities, for instance, the cross-section of currencies is going to be much smaller. So then we can focus on the strict assumption of no arbitrage by having that the stochastic discount factor is positive. So we don't have to rely on statistical arbitrage notions. So those that hold only the limit based on asymptotic theory. And in particular, we also don't have to rely on some regularization techniques in order to shrink the cross-section. All right, so then what we are going to do, we are going to define as the nonlinear arbitrage correction, the residual, right? It's a residual because it's going to be orthogonal to the linear model and it's going to be mean zero, that is going to render this linear benchmark model arbitrage free. So this is what we call our NAC or NAC. All right, so then we are going to ask a couple of questions. So in particular, we are going to ask what are the properties of the extracted NAC and of our stochastic discount factor M. And since NAC is going to depend on nonlinear returns, it's also very natural to ask whether it can help explain nonlinear payoff. So in the context of our paper, think about foreign exchange options. And then we are also going to ask whether an ACK is related to some existing financial indicators. So is it something new that we retrieve, or is it already subsumed by some existing financial indicators? And what we find is the following. We are going to find that NAC is going to help explain the cross-section of FX option returns. And since it's constructed as a measure that ex ante, it's in line with absence of arbitrage opportunities, it turns out that it can also help predict financial market dislocations. So what do I mean by financial market dislocation? Think about exposed realizations or violations from the law of one price in the data, and in particular in international financial markets, such dislocations have been encountered, especially if you were to think about the covered interest rate parity condition. But overall, we find that linear asset pricing models are going to perform well on average and during normal times, such that these nonlinear arbitrage corrections are small, whereas they're going to perform worse during distress periods. So especially during crisis times, the nonlinear arbitrage corrections are going to be higher. All right, so let me go to the theory. For the theory, we are going to have a very general market setting in which markets are incomplete. We know that if markets are incomplete, we can have an infinite number of different stochastic discount factors that are going to do the job. As it's customary, we are going to focus on representative from this set, right? And following Hansen and Jagannathan, we are going to focus on the minimum variance stochastic discount factor. And again, this is going to have a nice interpretation because we know that it's also going to bound the maximum attainable Sharpe ratio in the economy. We are going to let capital R bold denote the vector of excess return and R0 the risk-free rate. So the problem that we are going to focus on is the following. We are going to minimize the second moment of the stochastic discount factor such that it correctly prices the returns and the risk-free rate, right? So this is standard. What is new is that we are going to take very seriously this condition that M has to be positive. And how do we do that? By focusing on M that are going to be polynomials of even degree. And in our optimization, we are going to stop at the polynomial of second order degree, because already with that, we are able to ensure that the no arbitrage condition is satisfied. And since we focus on minimum variance, that's why we don't have to go to a higher order polynomial. Now, of course, you see here that we have conditional expectations. So in general, these conditional expectations are going to necessitate a model. Our optimization is going to be non-parametric, right? So this is one of the advantages of our approach, because we can actually accommodate any patterns that we observe in the data for returns in these international markets. So we also want to be model-free when we compute these conditional expectations. So the way by which we are going to do this, we are going to borrow from the machine learning literature. And we are going to learn these conditional expectations by using something which is called the kernel trick. Intuitively, you can think that when you have predictors and returns, an OLS will give you the best coefficients or optimal coefficients that best fit the data. With this kernel trick, you are going to have optimal functions that best fit the data. So you can think of it intuitively that we are going to have a linear regression on nonlinear components. The nice thing of our approach is that we can decompose the optimal solution into two components. The first one is going to be linear in the returns. This is the same with the classical Hansen and Jagannathan projection. This is going to be the leading term. And with it, we already satisfy these Euler pricing constraints. The nonlinear correction, it's only there to ensure that M is going to be positive. And another cool thing about our approach is that we show theoretically that our stochastic discount factor is going to induce an upper bound to both the Hansen-Jagannathan distance, but also to the Hansen-Jagannathan variance bound. And empirically, we also find these bounds to be very, very sharp. And then we are going to define as our nonlinear arbitrage correction the nonlinear component. So let me pause here for a second and talk a bit more about our nonlinear arbitrage correction and think about how we should actually think about it, right? So how should we think about this NAC or NAC? You can think of it as being a trade which is necessary for no arbitrage, right? And indeed, if we were to compute its premium, you would see that the premium is uniformly negative. How can you see that? Well, we know that the mean of this nonlinear component is 0. And if we were to compute its price using the stochastic discount factor M, since these two components are orthogonal, we are simply left with the second moment of the nonlinear arbitrage correction, right? So you see that this is going to be always negative. Intuitively, this is something that we typically use, especially if we wanted to hedge against market downturns. And in economic terms, you can think of it as being like the minimum cost that an investor who maximizes her Sharpe ratio would have to pay in order to insure against these weak arbitrage portfolios that are going to be generated from the linear model. All right. So this was it regarding the theory section. Now let me go to the empirical part and tell you a bit about the data. For the data, it's going to be very standard. We are going to have monthly returns from January 1985 to June 2020. We are going to have, as test assets, the local and foreign short-term bonds. Here, think about the 1-month deposit rate, and also the aggregate equity, which is simply the MSCI country index. The markets that we are going to focus on are going to be developed economies. We are going to take as the domestic market to be the US one. And as foreign currencies, we are going to consider the British pound, the Swiss franc, Japanese yen, the euro, Australian, Canadian, and New Zealand dollars. For conditioning variables, we are going to follow extant literature, and we are going to focus on the interest rate differential and the realized volatility of the exchange rates. So now the way by which we are going to solve for this optimization is by assuming bilateral trading. What does it mean? It means that if I'm domestic US investor, I can trade locally my short-term bond and the aggregate equity. Whereas let's say that Neil is going to be a Canadian investor, he can also trade locally the Canadian bond and the aggregate equity, whereas through the exchange rate, he can also trade the US one. And vice versa, I can also trade the Canadian dollar and the short-term bond and the aggregate equity through the exchange rate. So obviously, we are going to end up with 7 different specifications for some of these tests that I'm going to show you, and especially if we wanted to plot the time series of these 2 different indices, we are going to aggregate them by simply taking the average, but this is going to be consistent if we were to take a weighted average weighted by the gross domestic product, for instance. But again, when I'm going to show you some tests regarding the pricing performance, then we are going to use exactly the respective currency and the respective stochastic discount factor. All right, before actually showing you the time series, let me just quickly show you some summary statistics. And I know that this table is very big, but there are some key things to focus on here. We have the equity return. You see that on average, this is about 1%. The currency return is on average about 0.2% per month. And I'm also plotting here what are the minimum and maximum returns that were observed during the sample period of 50 years that we focus on, both for the equity return, but also for the currency return. So these are going to be relevant because toward the end of the presentation, I'm going to show you some simulation exercises in which we are going to look at some extreme scenarios and how does our nonlinear arbitrage correction index is going to behave. For the mean of the stochastic discount factor and its 2 components, you see that the mean of the stochastic discount factor is simply going to be the inverse of the gross risk-free bond, right, since we are pricing it, whereas we do find, as in the theory that the mean of this nonlinear correction is going to be 0 and its volatility is going to be very small. Again, it's going to be the minimal modification, so the smallest one that you can do to the linear model in order to ensure that the no arbitrage condition is satisfied. All right, so let me show you how the time series properties of this extracted nonlinear arbitrage correction is going to behave through time. So in the top panel, I'm plotting the US one. In the bottom panel, I'm plotting the international one. So the data goes from 1985 until 2020. And you see that in both cases, it's going to hover around the mean of 0, but most importantly, it's going to spike during bad times. And it's going to spike, especially during the Black Monday, but also during the financial crisis or the COVID-19 crisis. So what does it mean? It means that especially during those bad market times, the linear model is going to perform worse, right? Whereas whenever this NAC is going to be close to 0, it follows that the linear model is going to provide a good approximation of the return data. So obviously you may be wondering, how does the time series of the linear component of the stochastic discount factor is going to look like? And in particular, does it have like some properties that you would want it to have, especially if you were to think about intuitions from utility theory, for instance. And again, we find that the linear component of the stochastic discount factor is also going to be positive and large during financial distress periods, especially when the marginal utility of investors is also going to be high, right? And this is going to be true both in the US market, but also internationally. And you see that at least for these economies that we consider, and for these 4 assets and sample period, the linear component does not become negative in sample for the observed data points. However, still, the nonlinear component is not going to be exactly 0. Right, so what does it mean? It means that the benefit of our approach is that we do everything conditionally, right? And this is how we are actually going to validate the model to use it not only in sample for the observed data points, but particularly out of sample. Intuitively, if you were to think about what does this imply if one wanted to price, for instance, nonlinear payoffs, it would simply mean that during normal times, if you were to use the linear component, you would overprice nonlinear payoffs, whereas if you were to use it during bad times, you will underprice them. And in economic terms, it also means that insuring against this potential arbitrage portfolios generated by the linear model, insuring against them is going to become more expensive during crisis times. But again, our NAC is simply extracted from the no arbitrage condition. So it's not so much to ensure that it can provide good pricing performance on its own for assets with nonlinear payoffs. But still, a natural question arising is whether our nonlinear stochastic discount factor M is able to price nonlinear payoffs. And again, remember that in its construction, we only use information from basic asset returns. So think about the international stocks and bonds. So in order to test whether we can price nonlinear payoffs, we are going to focus on the following Euler pricing conditions, and we are going to see whether this pricing error is different from 0. And first, we are going to do this unconditionally. And as a test asset, we are going to consider the foreign exchange options. And I'm reporting here their pricing errors in basis points. In the foreign exchange option market, we only have like 5 strikes. So this is customary in this market. We have puts and calls at the money and puts and calls with a delta of 10 and 25 respectively. And again, we are going to have 7 different bilateral pairs. So you can see that for the vast majority of these test assets, we cannot reject the null that these pricing errors are going to be 0, meaning that with our stochastic discount factor, we will be able to price nonlinear payoffs. This is unconditionally. You may be wondering whether we can also price nonlinear payoffs conditionally. So as you can see, we have here 35 test assets. So let me just focus on the first line here and show you the time series plot of this pricing error. And this is how it looks like. Even if we were to compute the pricing error conditionally, right, through time, I'm plotting them here along with their 5 and 95 quantiles. You can see that they are not going to be different from 0. But importantly here, when we compute these conditional pricing errors, obviously our conditional expectations are going to change in order to reflect the underlying sample period, right? For these FX options, the sample period is smaller than our original sample period. And it turns out that by re-estimating this conditional expectation and the stochastic discount factor, in this case, we do find some instances in which the linear component is going to violate the no arbitrage condition, right? And in particular for the British pound, the euro, and for New Zealand, you see that there are different times at which the linear component will violate the no arbitrage condition in the sense that it's going to become negative. So for the British pound, when does this happen? It happens in 2018, which was like the first time when the British pound fell by more in the previous 40 years. So since the 1980s, this was a huge devaluation. For the euro, this happened in the aftermath of the euro debt crisis and during the COVID crisis. And for New Zealand, it happened during the 2008 financial crisis, and again, more recently during the COVID crisis. So this also, it's evidence highlighting the importance of accounting for nonlinearities and for NAC, because essentially with our stochastic discount factor, we would make sure that such violations do not occur, and we have a valid stochastic discount factor. So again, the NAC is going to be important because it's going to ensure that the no arbitrage condition is satisfied. You may be wondering still whether it has some additional relevance for nonlinear payoffs, right? But as I showed you in the beginning, NAC and the nonlinear component is going to be orthogonal to the linear model. So to test whether or not there is some additional information embedded in NAC, if we were to look at assets with nonlinear payoffs, we do the following. We investigate what is the relationship between nonlinear arbitrage correction and the unspent risk of assets with nonlinear payoffs. And first, we focus on foreign exchange options. And this is unspent risk by the linear model, meaning that first we take these FX option returns, we do a regression on the components of the linear model, take its residual, and look at the correlation between the residual and the NAC. And I'm plotting here this correlation between the nonlinear arbitrage correction and this FX option residual for the US dollar, Australian dollar pair. And now I'm providing this for the 5 moneyness categories that exist for the foreign exchange options and also for different maturities. So before, all the pricing errors were for 1 month fixed maturity. Here we have maturities that go from 1 month to 3 months, 6 months, and up to 1 year. And you can see that these correlations are in general positive, and especially for short-term maturity options, they are going to be higher, right? So overall, it appears to be a strong link between the nonlinear arbitrage correction and the FX option residual. And in particular, we find that this strong relation is going to be there, especially for commodity currencies. So think about the Australian dollar, Canadian dollar, and the New Zealand dollar. Why this might be the case? Well, because perhaps as previous studies have argued, they have showed that these 3 commodity currencies are special in the sense of being the importers of the world, but also that their currencies are going to be overall more volatile if you were to compare them with reserve currencies like the US dollar, the euro, or the Japanese yen. Another asset with nonlinear payoffs that we focus on is going to be the variance swap. So again, we are going to compute this correlation between the residual, right? So the unspent risk from running a regression of the foreign exchange variance swap on the linear model, taking the residual and computing the correlation with the NAC. And again, we have this for 4 different maturities going from 1 month to 1 year, and you see that, again, these correlations are going to be positive and statistically significant, meaning that there is going to be a non-trivial link also between the nonlinear arbitrage correction and the FX variance swap residuals. So overall, we do find that there is some additional information embedded in our NAC index with respect to assets with nonlinear payoffs. All right, so far I showed you that the nonlinear stochastic discount factor, the minimum variance one that we extract, can price nonlinear payoffs. You might be wondering whether it can also price some other test assets that were not included in its estimation, right? So for this, what we do, we are going to test its pricing performance, again, by the lens of these Euler pricing restrictions with respect to 2 new test assets that were not included in its estimation. So for this, we are going to borrow these portfolios from Hekeli and Manela, and we are going to have S&P 500 index option portfolios. There are 18 in total, and FX strategies portfolios that are going to be sorted on the interest rate and momentum. And you see, again, we do this test unconditionally, and again, we don't find that these pricing errors are going to be statistically different from 0. So this means that M, the minimum variance stochastic discount factor, which is a positive polynomial, is going to be able to price also other assets that are not included in its estimation, right? So, of course, positivity alone, it's not really enough in order to ensure a good pricing performance. With this test, we show that we have this good pricing performance also for other assets that are not included in the estimation of this stochastic discount factor. All right. With respect to the link between NAC and exchange rates in international markets, we have this result, which is called the asset market view. And in the asset market view, if we were to focus for simplicity for 1 second on the complete market case, so simply ignore what you see in red here, under complete markets, the asset market view would tell you that the change in the exchange rate is going to be exactly equal to the ratio between the foreign and domestic stochastic discount factor. Right, so there appears to be like a strong link between exchange rate changes and the 2 stochastic discount factors. So under complete markets, you have only 1 stochastic discount factor, and you go through foreign and domestic economies simply through a change of numeraire. Now, of course, in incomplete markets, there's going to be what is called a stochastic wedge, and it's going to break this strong link between exchange rate changes and the ratio of the foreign and domestic stochastic discount factors. Obviously, in incomplete markets, we are going to have different stochastic discount factors that are going to do the job. So each choice of the stochastic discount factor is going to give rise to different stochastic wedges. For our purposes, we care about the stochastic wedge, which is implied by the linear model, and the one that it's implied by the nonlinear model, and both are going to be minimum variance ones. Right, so intuitively, you can think that if markets are complete, the stochastic wedge is going to be exactly 0, right? So if you were to look at its volatility, it would also be 0. In incomplete markets, the more volatile this wedge is going to be, this is going to be a symptom of market incompleteness, right? So what we are going to do, we are going to extract the stochastic wedge both for the linear model and for the nonlinear model, and we are going to look at the ratio between their volatilities. Why? Because we want to answer the question of whether or not linear models are going to understate or overstate market incompleteness. So what is the idea here? Again, we are going to look at the ratio between the volatilities of the stochastic wedge, which is implied by the linear model, and the volatility of the stochastic wedge, which is implied by the nonlinear model. Obviously, if this is positive, it means that with the linear model, we will be overstating market incompleteness. If this is negative, we would be understating it. We estimate this in the data for the currencies that we consider, and you can see that on average, this is about 8%. So it follows that the linear model is going to overstate the degree of market incompleteness. So taking nonlinearities into account in the form of NAC is going to help enhance market completeness internationally. All right, another test that we do is to ask whether our extracted nonlinear arbitrage condition index, which is extracted ex ante to be consistent with the non-arbitrage condition, can be informative about future observed violations from the law of one price in the data. So for this, we are going to focus on CIP violations. Right, so this idea that the covered interest rate parity was the textbook example of no arbitrage, right? If you were to look at the forward exchange rate, this should be equal to the spot exchange rate and multiplied by the interest rate differential. Duteper and Verdeland has shown that following the financial crisis, this CIP condition is going to be violated in the data, and this is going to be more so after the financial crisis. And another index that we are going to focus on is called this market dislocation index, which again is going to proxy for the commonality in frictions that could lead to limits to arbitrage in international markets. So here there are like 3 such examples. Again, we will have the CIP violations, but also this idea of triangular arbitrage, right? So for the fact that if we were to have 3 currencies, think about the US dollar, Canadian dollar, and the Swiss franc, for instance, if we know 2 exchange rates, we could infer what is going to be the 3rd exchange rate. In practice, if you were to look at this triangular arbitrage condition, sometimes this is going to be violated in the data. And the 3rd such example is going to be ADRs, or American Depository Receipts. So the fact that when a foreign firm is going to trade in the US, the price at which it's going to trade is going to be slightly different than the foreign price. All right, so what do we do then? We are going to run both contemporaneous regression on these different violations from the law of one price observed in the data on our NAC, both contemporaneously, but also predictive regression. And you can see that in both cases, not only for this market dislocation index, but in particular for the covered interest rate parity violation at different tenors, starting from 3 months to 10 years. This is going to be like a strong relationship between the two, in the sense that with our nonlinear arbitrage correction, we are going to be able to explain, but also predict these future violations from the law of one price in the data. And importantly, these relations are also going to hold out of sample, right? So it means that with our nonlinear arbitrage correction, which is extracted ex ante to be consistent with the no arbitrage condition, this is going to be informative about future violations from the law of one price in the data in related markets. All right, so then we are going to ask what are going to be some potential determinants for our NAC. And if you remember this counter-cyclical pattern that I have shown you at the beginning, you may be thinking of things like financial uncertainty, VIX, or some proxies of illiquidity, and so on. So this is what we are going to try to test here. In all of these plots, the dashed black line is going to be our US or domestic nonlinear arbitrage condition correction index, whereas the other ones are going to be different proxies. In the top panel, we have the financial uncertainty index, which is taken from Jurado, Ludwigson, and Eng. So think of it as simply being like the conditional volatility that is going to be extracted from the residual from a large panel of economic indicators that also includes things like stocks, but also things like GDP growth, unemployment, and so on. Then we have the NAC and the VIX, which is another typical measure that investors use to assess like the economic uncertainty or like a measure of fear. Then we have the intermediary leverage ratio squared. This is again taken from the paper of Hey, Kelly, and Manella. Why do we focus on the intermediary leverage ratio squared? Well, because our NAC is also going to be nonlinear, right? And in fact, if you were to compute the correlation between NAC and the intermediary capital risk factor, this would be 0, whereas our linear component of the SDF is going to correlate very highly with the intermediary capital risk factor. And the last measure that we are going to focus on is going to be the TED spread, which is another measure of funding liquidity constraints that is typically used. Obviously, you can see that there's going to be a positive co-movement between these different variables. To test this relationship more formally in the data, we simply run time series regression. And you see that in all of the cases, there's going to be a strong and statistically significant relation. However, all of these different variables are going to be able to explain at most 30% of the time series variation in our nonlinear arbitrage correction index. So what does it mean? It means that our NAC is going to embed some relevant non-redundant information, right? So it's not only theoretically motivated from the no arbitrage condition, but it's also going to be economically meaningful. And it's economically meaningful because, as I showed you before, it's going to be able to explain things like nonlinear payoffs, but also predict future violations from the law of one price in the data. And it's also meaningful if one was to consider how to complete international financial markets. But still, I showed you that uncertainty and liquidity are going to be related to NAC. You may be wondering, how does our NAC change if we were to add these two components to the linear model, right? If you were to add these two components to the linear model, if NAC was truly redundant, then you should see that it goes to 0. So what we do next, we re-estimate the model by extending the linear component to account for traded uncertainty and liquidity factors. And again, I'm going to plot here the time series of our original benchmark NAC and the augmented one, which accounts additionally for uncertainty and liquidity. And you see that it's not going to be very different. In fact, they're going to have like a positive correlation of around 60%. So it means that even if you were to extend the linear model to additionally account for uncertainty and liquidity, our nonlinear arbitrage correction is still going to be important. All right. Now, in the last 10 minutes or so, what I want to show you is what is the relation between our polynomial stochastic discount factor and some existing stochastic discount factor approaches that are nonlinear and also polynomial, right? So we are not the first to consider polynomial stochastic discount factor models. However, we are the first to consider positive polynomial stochastic discount factors, right? So here, consider this cubic model from Dietmar, in which the stochastic discount factor M is going to be a function up to order 3 on the aggregate wealth, right? And from utility theory, one can impose sign restrictions on these coefficients. Obviously, this M in its form is not ensured to always be positive, right? So unless we have that this third component is equal to 0, M can become negative. And while utility theory is going to be very important to help us impose like some sign restriction when we have like a univariate model, in a multivariate model like ours, it's going to be much difficult to do so, right? And in multivariate models, we could also care about cross terms, right? So as an investor, perhaps we care about things like the leverage effect. So we want to see what is the interaction between an asset
Right.
Just lose Mirela?
No, we regain here, but Mirela, you need to share, and we'll continue.
Okay.
All right, so can you hear me now?
Yeah, everything is fine.
Perfect.
If you can go full screen, that would be perfect.
Perfect. Yes. So blame the Ross School of Business. All right. So was it here that you lost me or? Perfect. All right. So again, using utility theory, we could impose sign restrictions on a univariate model. However, we cannot do that if we had like a multivariate model as ours. But still, we want to extract from here what is going to be the residual if one was to compute the difference between this cubic model and the linear component. But still, in this case, just remember that the residual is not going to be orthogonal to the linear model, whereas our NAC will be orthogonal to the linear model. So our NAC is going to be orthogonal, so it's going to have no price impact, but it's also going to have minimal volatility. So I'm plotting here the difference between the two. Ours is going to be the dashed black line, the residual, so the difference between the nonlinear cubic model and the linear one is going to be the red line. So you see that there's going to have a larger volatility, but also it's going to have a huge price impact because this residual is going to have a 70% correlation with the linear model. And if one were to plot the two stochastic discount factors, they are going to deviate substantially and more so in the tails. Another comparison that I wanted to highlight is this idea that we do find theoretically that our approach is going to bound, it's going to induce an upper bound on the Hansen-Jagannathan distance and the Hansen-Jagannathan bound. And empirically, we find this bound to be very tight, right? So here, I'm plotting in the top panel the minimum variance bound between our minimum variance positive polynomial stochastic discount factor and the non-negative minimum variance stochastic discount factor of Hansen and Jagannathan. So this positive part of the linear model. And you see that it's going to be very tight. This is 10 to the minus 5. Whereas in the bottom panel, I'm plotting a minimum entropy bound. So this difference between a Kullback-Leibler divergence and again, the Hansen-Jagannathan non-negative one. And you see that this one is also going to be tight, but it's going to be on average around 1 order of magnitude higher than ours. So overall, these bounds are going to be tight in the data, but the important thing for us is that in our approach, we are going to nest the linear model as a special case, right? And the linear model is going to be the leading term and is going to price correctly the assets that enter the linear span, again, international stocks and bonds. All right, so the last thing that I want to show you is this idea that one could maybe concern about the fact that if you were to consider a polynomial stochastic discount factor, this is going to be convex in the underlying return data, right? So if you were to think about utility theory, again, you would want to see this nice downward sloping shape in the market excess return with respect to your stochastic discount factor, right? So to alleviate such concerns, we do several things. First, we plot how this shape looks like in the data, right? So we plot our minimum variance stochastic discount factor as a function of the market excess return. And we do that both for the stochastic discount factor, which is going to be this black triangle, but also for the linear component, which is going to be the red circle. And you see that in the data, we do find this nice downward sloping shape in the market excess return. This is in the data, and our approach is non-parametric. You may be wondering how this was going to look like in some simulation in which we can assume some parametric specifications for the underlying return data. So we do this by focusing on Gaussian log returns, right? And I'm plotting here, like in the paper, we have more scenarios. Here I'm plotting like the worst case scenarios in which we have an annualized high mean of 11% and two different annualized volatility, one which is low and one which is high. And obviously it's much harder with a low volatility to be able to match a very high mean of these returns. In all of these plots, I'm plotting in black the stochastic discount factor, and in red, the dashed line is going to be the linear component. So you see that they are very, very similar to each other, meaning that our nonlinear arbitrage correction is going to be small. This is what happens under Gaussian returns. Of course, with Gaussian returns, we have relatively thin tails. So what we are going to do, we are also going to consider Laplace returns, because we know that here we can generate some fatter tails. So you see that especially in this case in which we have a low volatility and a high mean scenario, M is going to start to slightly curve upwards, but only at return data that were never observed under the markets that we consider, right? So overall, this evidence suggests that we don't have this concern that we may have this non-monotonicity with respect to the relationship between the stochastic discount factor and the market excess return. So overall, in the simulation exercises, we show that NACs well behaved under these parametric assumptions, but again, its power comes from the fact that it's going to be estimated non-parametrically, and it can accommodate the actual return data that we observe. So we don't have to impose any strict distributional assumptions or strict preferences for investors, and we can accommodate also things like structural shifts in the data and so on. All right, so let me wrap up. In conclusion, what do? We are going to introduce this nonlinear arbitrage correction. They are from basic asset returns alone. Think about international stocks and bonds. It's going to be consistent with linear model. It's fast to compute and fully conditional. And we show that the properties is going to be counter-cyclical, and is going to be related to nonlinear payoffs like foreign exchange options, but also foreign exchange variance swaps. Empirically, we also find that our nonlinear arbitrage corrections are going to be able to predict future violations from the law of one price, including covered interest rate parity deviations. And overall, we show that linear asset pricing models are going to perform well on average and during normal times, such that this nonlinear arbitrage correction is going to be small, whereas during bad times, we are going to have higher nonlinear arbitrage corrections. So linear models are going to perform worse during these distress periods. So thank you very much, and I look forward to the questions and comments.
So thanks, Mirela. I thought that was very clear. Maybe so clear that there weren't any questions, but we'd like to give people a last chance to ask questions. So if you have a question, please feel free to unmute yourself and use your microphone to ask.
I mean, while people are thinking, for me, like the biggest takeaway is just like I appreciate the FX market, but is there a way to kind of have more applications in the equity market that many people are more familiar with? So I know you had some of those test assets from the S&P 500 index options, but is there kind of, what are the implications for the US equity market?
So this is an excellent question, and in fact, we are working on a new paper in which we are going to look exactly at that. But you can think that with equities, we are going to have a larger cross-section, right? And with a larger cross-section, we cannot price all of these assets exactly, such that the pricing error is exactly zero. So there, what we are going to have, essentially, we want to see how some benchmark linear models, think about the CAPM, Fama French 3-factor model, 5-factor model, or this intermediary risk factor models. What is going to be essentially the nonlinear arbitrage correction that is going to be implied by all of these models. And there we want to study whether you actually need like more factors or more nonlinearities. And it's still a work in progress, but essentially we do show that nonlinearities are going to be important, but more so for the no arbitrage restriction, and especially if you wanted to price things out of sample. So it's a way by which you can validate the model, especially if you want to use it in an out-of-sample context. And also with this nonlinear arbitrage correction, we will be actually able to explain things like low risk anomalies, right? The fact that if you were to look at low beta stocks, they have higher returns. High beta stocks have low future returns. So we show that with this nonlinear arbitrage correction, you can explain these low risk anomalies, and it's not only going to be due to cost skewness, for instance, but it's more than just cost skewness.
So let me ask you a naive question about your third bullet point, right?
Sure.
So in your framework, violations of the law of one price don't exist, right? Because you have a no arbitrage framework. So how should I think about the fact that NAC predicts violations of the law of one price?
Sure. So NAC is going to be constructed assuming no arbitrage, but in the basic market, right? That only has the aggregate equity, the bond, and the currency. And then we look in related markets, like the forward, foreign exchange, and so on, and see that there, this nonlinear arbitrage correction is going to be informative. So all we are saying is that there are many ways by which someone can extract nonlinearities or introduce nonlinearities in a model. Ours comes only from the no arbitrage condition. Right? So since it's identified from the no arbitrage condition, we then ask, is it actually related to some arbitrage activity exposed? Obviously, it's very hard to actually measure or quantify this arbitrage activity. So then we focus on existing proxies that are available in this market, and in particular, these deviations from the law of one price in the data. Obviously, if we were to include in our estimations like the forward exchange rates, prices, and so on, the NAC will look differently.
Thank you. Actually, I'm glad you were able to understand me. As I was speaking, Zoom asked me if I wanted to switch my speaking language to Ukrainian because I was speaking Ukrainian.
I'm glad
So
it didn't
I'm
ask
glad
me
you
that.
were able to understand my Ukrainian. Are there any other questions?